Hello and welcome to this Tuesday's morning market briefing. We've got lots to talk about, but firstly, Dimon warns rates could stay high as the market mood does shift. As well as that, the US, UK and Australia say Japan could join as a part of the Aukus pact. We've got lots to talk about in the charts. Also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is to do with Dimon and JP Morgan. Now, the CEO of JP Morgan has now said that US inflation and US interest rates could stay higher for longer. This comes as a result of high government spending maintaining price pressures in the US. Now, this is, of course, a very important article and a very important article to kind of note in regards to, of course, US inflation and US interest rates, which is, of course, two topics which we are kind of always covering here on this channel, largely because, of course, both of those kind of, individual economic indicators or, economic kind of facts ultimately playing a great deal into the way the market does move and where markets then will be heading, as ultimately, the interest rates do affect the dollar, for example, greatly, as well as just all US equity markets. And then on the note of inflation, of course affects the perception of the market and of the Fed's perception of where rates should be. So both kind of work in lieu of one another, of course, and both are very important to kind of understanding the other. And so, we're kind of in this interesting situation at the moment in regards to US inflation and interest rates, where, ending off last year, we were starting to see US inflation come down, and investors therefore became very optimistic about the outlook for the US economy. And many started to believe that rate cuts for the US could start to come as early as March in 2024. Now that we are past that period, however, though, we know that is certainly not the case, and this is largely as a result of basically ever since the start of the new year 2024, we really started to see inflation remain persistent, and that's kind of going against what the expectations of traders was, but really not going against the expectations of the Fed. The Fed has kind of constantly been hesitant and providing a more hawkish outlook on the markets since September of last year, and so even when investors were starting to become very optimistic and starting to expect rate cuts as early as March, the Fed kind of remained very passive and kind of reassured markets and individuals that ultimately more inflation data needed to be seen for the Fed to start making any decisions on rate cuts or even start talking about rate cuts. And this was similar rhetoric across the pond as well in Europe, with the Eurozone, with the ECB, of course, in the Eurozone, and the Bank of England in Britain, both kind of reiterating the same sort of comments that we were hearing from the Fed over inflation and interest rates. That said, however, the Fed did in February, I think it was February, start to make certain predictions on how many rate cuts they were to make this year, that being 3 rate cuts, 0.25 percentage point rate cuts this year. And this was in contrast to what investors were actually believing, which in the swap markets kind of priced in at 6 of those 0.25 percentage point rate cuts. So markets were very optimistic, expecting lots of rate cuts, expecting a very dovish policy being implemented by the Fed, yet the Fed was kind of reiterating this very calm message of, ultimately we need more data. And, as time has progressed, as we've now moved through the month of March, we've seen actually some more negative kind of inflation data start to arise, and, certain price pressures within the economy have certainly become more present, with ultimately the labour market proving to be very tight, and ultimately inflation remaining, proving to be persistent, which kind of played into Jerome Powell's comments last year, last year and before, where he was really reiterating the fact that ultimately, despite what we may have seen in the past 2 or 3 months inflation data wise, things can change quickly. There's lots of risks at the moment, especially geopolitical wise, which of course is affecting inflation in the sense of oil's price and that kind of thing, and also trading in the sense of shipping times and stuff like that. So all of these kind of factors were ultimately affecting inflation, and investors were kind of quick to disregard that for the short-term figures that we were seeing. And now, as inflation has remained more persistent, the Fed's kind of predictions and rhetoric has kind of proven to be true. And ultimately now, what we're actually seeing is investors and traders become more hawkish, more pessimistic about the outlook for inflation than the Fed itself. So a very interesting change there in the divergence between the two groups of people, that being the Fed, the key financial institutions, and of course the traders and investors of the world in relation to the US markets. So a very interesting situation where we have those two groups which are kind of diverging on those points. And here we have, of course, the CEO of JP Morgan, probably the most important and influential financial institution, investment bank in the world, and especially in the US, and we have the CEO of it kind of warning us now about rates staying higher for longer and inflation staying higher for longer, which is kind of now more aligning with what we've been hearing from traders recently, but definitely creating this kind of worrying image for US markets. And obviously, providing a great deal of kind of bullish support to something like the dollar. So, we're in a very interesting situation here. Now, what did Jamie Dimon actually say? Well, with his annual letter to shareholders, he said that JP Morgan had plans for interest rates both going above 6% as well as going below as low as 2%. So, preparing for both extremes. All these comments come just as the markets have begun to reel back their rate cut expectations for this year, with markets now being more hawkish than the Fed itself, with markets pricing in just two 0.25 percentage point rate cuts by the Fed in 2024, which is in comparison to the Fed's own expectations at the start of the year for 3 rate cuts. The change in traders' outlook is beyond dramatic, however, with investors at the start of the year expecting 6 to 7 0.25 percentage point rate cuts. Jamie Dimon's key warning in his letter to shareholders, however, was on the topic of a potential boom in private equity, which he warned was a fast-growing industry with some bad players, which was creating an unexpected risk in the markets, with him saying that ultimately it would be a reasonable assumption that at some point regulations will focus on the private market as much as they already do with public markets. Dimon also worried about an ominous Dimon also provided an ominous outlook on the world and the current heightened tensions, saying that the recent geopolitical events in Ukraine and the Middle East could be creating risks that even eclipse anything since World War II. So ultimately, very interesting article here, and a very important one to note, of course, on the topic of interest rates and inflation. So definitely keep your eyes on that. That's all to talk about in this article, though. Next article to talk about is to do with the Aukus pact, which of course we covered in great lengths yesterday, talking of course about this expected meeting and expected announcement and speech which was to take place yesterday with those Aukus defence ministers. Now, the US, UK and Australia have now all said that they are considering involving Japan in Aukus in an effort to bolster the current trilateral Aukus security pact, which is created in a way to create a deterrence against China, with the Aukus defence ministers saying that they would consider bringing Japan into pillar 2 of the Aukus pact, which focuses on undersea weapon technology and other such weapons. So obviously we did cover this kind of topic yesterday, and that was all in kind of presumption of what happened to yesterday in this defence minister's speech, which now has taken place. And there we really kind of did see the same things that we were expecting. Now, what were we expecting? Well, we had mainly spoken, about how the US is the key player here, which is of course pushing for Japan to join the kind of Aukus pact, with the belief kind of being that as Japan has been increasing its defense spending over the past few years, but especially past year or so, ultimately Japan would be a key asset to kind of bring into the pact and help protect the Indo-Pacific region. As of course with the current threats to China invading Taiwan, we know that China of course has been redeveloping its kind of military base for quite some years now, and that's expected to end maybe in 2027. And we know, of course, that most recently the more progressive party of Taiwan was kind of re-elected to kind of run Taiwan. So we once again had another kind of fear, and we were once again worried over the potential invasion of China into Taiwan. So that was kind of a key worry that we noted. And as well as that, we know that China's trying to expand its influence in the South China Sea, attacking certain merchant vessels, and also kind of trying to set up their own islands and that kind of thing, artificial islands within the area to expand its own kind of influence. And so all these kind of factors have definitely weighed on certain players within that region, which have become quite defensive and worried about the potential invasion of their own nation or expansion of their own nation. That's been very key in nations such as Taiwan, the Philippines, and even whilst it might seem quite extreme and unlikely, even the likes of Australia and South Korea. So all those players within the region have kind of focused on their own defense, increased defense spending, and thought about how they could kind of defend against a Chinese invasion. And Japan is of course a very key player within the region, which has islands extending all the way up to Taiwan, so has its personal interest also in the idea of defending Taiwan should Taiwan get invaded. So that does explain why the US wants Japan in, yet we know that UK and Australia are kind of worried about the prospect of actually admitting Japan into this alliance. Now, the AUKUS defense ministers justified their interest in admitting Japan on the grounds that all of the AUKUS partners are committed to delivering advanced military capabilities to their own forces, so engaging like-minded partners would not only help everyone involved. According to the Financial Times, however, the AUKUS alliance allies will have to take into consideration some reservations about Japan's security and data protection systems. Therefore, despite what some defense experts have expected, the three AUKUS allies did not invite Japan into the so-called JAUKUS alliance, which would place Japan as an equal member in the current AUKUS alliance. What it does show, however, is that AUKUS is greatly interested in working with Japan. Japan, however, seems to need to fix its own security issues first. So very interesting article here, following up after yesterday's morning market briefing where we did talk about this topic, and this is certainly something which is going to raise world tensions, and is something that's certainly very important to keep your eyes on. That's all to talk about in the articles, though. Lastly, next to talk about is of course the charts, where we do have some very interesting things happening. Now, of course, we've painted this kind of hawkish picture for the US monetary policy recently, high inflation pressures, rates being expected to stay higher for longer, and this kind of very worrying image therefore being painted for US equities also. And as a result of that, over recent days and basically last week, we did see the US equities prices start to kind of fall to the downside, and we've seen therefore especially the Dow Jones really begin to make its way to the downside, and price did near this key liquidity zone just ending off last week, but price did not of course fully make it to that level, and since then we have seen this kind of short-term retracement take place, with price now making its way back up to this key 50% Fibonacci retracement level, with this level of course being very important in our eyes when we're looking to see whether price will continue to the downside. So that's why we've marked out this key Fibonacci retracement tool, and we're looking to see how price reacts. Now yesterday it does seem like price made its way up to that area and is now kind of stalled out and is waiting to decide to almost move to the downside, or not. So the question will be, of course, today, whether price does now continue a move to the downside from this 50% Fibonacci retracement level, or in fact was this just kind of a blip within the market, and US equities are now going to continue their rally to the upside. So definitely keep your eyes on the Dow Jones, very interesting US equity index to talk about and look at the moment. Next to talk about though is the dollar, which of course still on the topic of kind of US monetary policy and that kind of thing, but I think an important thing to note is of course that yesterday we didn't receive much interesting news in regards to the US in any fundamental news way, so no key economic data points to kind of note, or no key key data releases and that kind of thing, or news points to note, which may push the dollar or US equities one way or another, and that's why we've kind of seen price move quite slowly, and the same is to be said today. So maybe the dollar won't be moving the most today, but ultimately we still are getting an incredible amount of very important data this week, as I noted in yesterday's weekly market briefing. Now, where is price currently on the dollar? Well, ultimately, price has been running to the upside on the dollar since really, the 8th of March, as I've just noted there, but as price was making its way to the upside, of course, we did see kind of this bearish divergence form on the dollar, on the RSI index for the dollar, with price then selling off from this key liquidity zone just up here around that level, and price has now made its way to the downside somewhat, breaking once again below this key liquidity zone, and is now kind of reacted to this 6180 level and has moved up to the upside and reacted once again with this new liquidity zone and is now selling off once again. So ultimately the dollar's in a very interesting level where price is almost ranging, it's waiting for this key economic data. So I don't think these kind of Fibonacci retracement levels are going to actually affect price much. We're going to be waiting for those key economic data points this week before the dollar starts moving in interesting ways. Next to talk about though is Euro USD, which despite not having much key economic data yesterday nor today, price has moved up as we've started off the week, with price now kind of just within this liquidity zone, if not breaching out of it just right now. The question will be, of course, whether price will actually break out of this level and maybe even hook back and then continue higher or something like that. But definitely keep your eyes on Euro USD, very interesting levels at the moment. Next to talk about is pound yen, which is in a very interesting kind of situation at the moment, as ultimately it's kind of ignored this key liquidity zone as we've started off the week and instead has just continued to push higher. That said, it's pushed higher to this kind of range high around the 6180 Fibonacci retracement level. So the question will be then, of course, whether price can break above that level and continue higher, or in fact will price once again sell off from that key zone and make its way to the downside after forming a double top. So certainly keep your eyes on pound yen, very interesting levels. Next to talk about though is Bitcoin, which of course, incredibly volatile recently, and some outrageous moves taking place basically, but ultimately after price has kind of reacted to numerous Fibonacci retracement levels over the past 2 weeks or so, price has now made an upswing and has broken above these kind of range highs that were forming, which we kind of didn't really expect price to then break above until maybe price had made its way a bit lower first and gained that liquidity. The liquidity does seem like it has been gained though, and price is now very much near these all-time highs, only around $2,000 at Bitcoin off those levels, if not less. So certainly Bitcoin's very close to those all-time highs now, and the question will be then today whether price will then continue to run from this liquidity zone to the upside and break above that area, or in fact will price stall out and not gain the momentum needed to break above that key high. Next to talk about though is gold. Gold has continued higher but has kind of stalled out now at these all-time highs, but gold's just at an outrageous level at the moment, of course, and this is despite the more hawkish rhetoric that we're hearing from the Fed, but possibly this is also just because ultimately people are now coming to terms with the fact that inflation may just stay higher for longer forever, and whilst that may mean that the Fed keeps interest rates higher, that also means that there is a good buy side opportunity on gold to hedge themselves against inflation, despite what the Fed's saying, because clearly the Fed's influence with interest rates isn't having the key effect that it needs to have on inflation to bring it down. So price is still high on the on gold, no retracement yet seen, and price is still at those all-time highs. Next to talk about, and lastly to talk about on the charts, is oil, which has sold off and is now just once again below this kind of key liquidity zone, which we've noted from ages ago, but price does seem like it's interacting with that level. So the question will be whether price has made those all-time highs. That said, tensions are much ramping up within the Middle East, but we're not seeing Iran react to Israel in the way that we were expecting. So maybe, oil has some downside opportunity should nothing kind of escalate within the Middle East anymore, but definitely keep your eyes on that region if you want to kind of keep trading oil at the moment. That's all to talk about on the charts though, lots covered. Lastly to talk about, of course, is the economic calendar. To be honest, we're not getting much economic data today. Not all of it's loaded in anyway, but we're not getting much economic data today, nor is any of it really that significant, but there's still some things to listen out for. Firstly, we're getting one Fed official speech, followed by the British retail sales figure, followed by the Aussie consumer confidence figure, and then the Japanese consumer confidence figure. Followed by that, we're getting the French balance of trade figure, and then finally, we're having one Swiss central bank speech. So, not too much data to talk about. We've covered lots on the economic calendar. We've covered lots on the articles, lots on the charts, and lots on the economic calendar. That's all from us at Wildwood Capital. Hope you have a great trading day. See you later.